Kitco News, special coverage of the Vancouver Resource Investment Conference, is brought to you by First Mining Gold.
We're discussing the state of economic affairs around the world with Mark Skousen, editor of Forecasts and Strategies. Mark has correctly called many important financial events in the last 40 years, including the crash of 1987, which we talked about on our program in prior episodes. But good to see you finally in person, Mark. Welcome to Vancouver.
Yeah, thank you. It's nice to be here. And you go all the way back to 1987. That's a long time. That was my 40th birthday, by the way.
It was, yeah.
October 19th.
You told me the story. A bunch of your clients, I think it was, you had told your clients ahead of the crash of 87 in October.
To get out.
Get out. And then you had your 40th birthday in celebration of, partly because it was your 40th birthday, but also because you were right.
and it wasn't a very festive occasion, I can tell you that.
No.
And you know what's funny? I've never predicted a crash since then because you have government interfering to keep the crash from happening. Now, they can't stop a bear market, and we're in a bear market right now, but we haven't had a crash. We haven't had a 22% crash in the market in one day since 87.
You wouldn't call this correction a crash? You would. I mean, we had a 24% correction in the NASDAQ since the beginning of the year, 16% down.
So that's 5 months. That's not one day.
No.
And so the market is, the NASDAQ is down 25% in 5 months. So they've spread it out over a long period of time. So bear markets are with us. We're in a bear market. I think we're coming to the end of the bear market for a number of reasons. But this is the price we paid for the excessive inflation of 2020 and 2021, where the money supply, over the last 3 years, the stock of money has increased 45%. If you look at M3, one of the broader based money supply figures, but it's been going up like this and then going down the rate of change.
Yeah.
And this is the Austrian theory of the business cycle, which basically says inflation is unstable, that it creates price inflation that is more rapid than you expect. But then the correction is also difficult to control. And so we're suffering from the inflationary boom, and now we're facing the inflationary bust, if you will. So it's a pattern that the Fed has adopted for many years. They have a boom-bust strategy. They fight recession for a number of years. They increase the money supply. They reduce the interest rates. They engage in quantitative easing. They do all of those things. And then they reverse themselves when price inflation shows up, and they raise rates, and they reduce the growth of the money supply, and they sell off some of their quantitative easing, QE, quantitative assets that they have. So that's what we're seeing right now. And frankly, I think with the rising rates, that's why gold has not done well. Gold's done okay compared to the stock market, but silver's down. A lot of the oil's actually been in a major bull market, and that's for a number of other reasons.
I want to come back to oil and gold, but just on the Fed and monetary policy, this is the first time in many, many years that we've seen interest rates higher than zero. So this is the end of the zero interest rate environment, if you want to call it that. Yeah. It's a new phenomenon for a lot of younger fund managers out there. No, but people who have just entered the business in the last couple of years have not seen this phenomenon yet. What does this mean for the markets at large?
There's a couple of things that are really tough for the Fed to deal with. First of all, you still have a positive yield curve, so long-term rates are higher than short-term. So that's a good thing. When you have a negative yield curve where the short-term rates are higher than the long-term rates, that usually means a recession. And so we may be moving toward a recession, but I think it'll be a relatively mild recession because I don't think the Fed is determined to fight inflation like Paul Volcker did. And one of the reasons is we have this high debt problem in the United States and other Western countries. So the $30 trillion debt that we owe, when you start raising rates, look what you're going to have to pay in terms of interest on the debt. Yeah. I mean, that's going to skyrocket, and that's going to disturb everybody, Republicans and Democrats. And so I think the Fed is going to have to pull back and allow a little bit more inflation than they have before. You had an inflation target of 2%. I don't think they're going to go back down to that. It'll probably go down to 4% if they're lucky.
People talk about the rise of the debt level, which is true. $30 trillion of debt is the highest we've ever had. The debt to GDP level is still low relative to countries like Japan, for example. So when you compare it to other G7 countries, the U.S. is relatively not as in debt. Would you agree with the analysis that maybe the Fed actually, or the Treasury actually could afford to pay off interest expenses on $30 trillion of debt, even if interest rates go up, just because maybe the economy could grow even further?
Yeah, I don't really buy that because Japan has been in a slow growth economy for some time. And I think that high levels of debt have held back Japan. And so the U.S. is in a stagflation economy. The real GDP was negative for the first quarter, maybe negative for the second quarter. My own gross output statistic, GO, measures spending at all stages of production, anticipated the decline in GDP because when the supply chain is growing at a slower rate than final output, that's a sign that we're slowing down. We could be going into recession. So the revenues may not be there. The deficit may balloon. And when you have rising rates with an increasing deficit, and thank goodness the Biden administration was stopped from expanding the deficit even more, thanks to Senator Joe Manchin, who single-handedly stopped the huge deficit spending programs of the Biden administration. So that was good. But look, as interest rates get higher and higher, I mean, who's to say how much money you're going to have to pay just on the debt? This is going to be a serious problem. Hasn't been a problem in the past because we could finance the deficit with very low interest rates. But as interest rates get up to 3 or 4 or 5%, boy, that interest on the debt's going to balloon.
The Biden administration has made fighting inflation a national priority per his announcement last week. How do you think they're going to do this?
It reminds me a little bit of Jimmy Carter, who said, we're going to fight inflation, and he really didn't do much in that respect. He finally did at the end of his administration by appointing Paul Volcker. It wasn't Ronald Reagan, it was Jimmy Carter that appointed the anti-inflation czar, Fed czar. So the proof is in the pudding, and Biden what has he done? He canceled 3 leases, including one in Alaska for oil and gas. I mean, how's that supposed to fight inflation? And look what happened. Oil prices suddenly spiked up again. I think Biden is clueless. It's easy to simply say we're going to fight inflation. But to actually fight it, not cause a major recession, that's really a tough task.
How should they do it?
Well, they need to maintain the Biden or the Trump tax cut, the corporate tax rate. That stimulates the economy. You want to avoid too much regulation of the economy. So I like the deregulatory environment that Trump had in that respect. Anything you can do to reduce taxes, reduce regulations, that will help recover. And we need to stop expanding the money supply at a rapid pace. And we're moving in that direction. So I do think that a gradual increase in interest rates, what the Fed is doing currently, that's appropriate. And at some point, the economy will stabilize, the inflation will stabilize, and we'll be back to a normal growing economy.
Okay. Growing economy. Now, growing in what sense? Because I've heard that we're headed towards a recession from multiple people I've talked to here at the conference. Financial institutions are saying the same thing. Goldman Sachs just released recently that they think it's very, very likely we're going to get a recession in the U.S. sometime soon. What do you think?
So I think it's a mild recession for a couple of reasons. One is the technology revolution is still very much with us. So we give a lot of incentives to people to create wealth and to come up with new products and increase quantity, quality, and variety of goods and services. So that's and the Trump tax cuts are still in place. I think there's a lot going for us. Here's another thing that's really important. In 2008, corporations were flat-footed. They were heavily in debt. They faced a major crisis. Today, look at how many companies, Microsoft, Apple, Google, all of them have trillions of dollars in cash. Billions of dollars in cash. So they've cut costs to the bone. We have a labor shortage right now. Who ever heard of a recession with a labor shortage? So there's a lot of positive things out there that we shouldn't ignore.
Okay.
Slow growth is the way I call it, or if it's a recession, I don't think it's a deep recession. I don't see a 2008 financial crisis occurring at this point.
What about stagflation? You brought up the possibility of stagflation. What parallels can you draw between this stagflationary environment and that of the late 70s?
So I think it's similar in the sense of energy crisis. You had spiking oil prices. That's very, you have food shortages. You have supply chain problems. All of that is very real. Now, of course, it's for different reasons. The pandemic is the one, I should say the lockdown, not the pandemic. Yeah. It was our response to the pandemic that we overdid it. But free markets respond to these sort of things. So I'm optimistic that the supply chain problems will be overcome over a year period of time. So again, my optimism is still there. And here's the other thing. Another thing is political, because Biden and the Democrats have proposed so many radical solutions to problems, and they're not solving any problems. They're making things worse. The Republicans should take over Capitol Hill. And so Biden is now going to have to work with a majority of Republicans on Capitol Hill. That's positive. So you're not going to have any negative news except for maybe some executive orders that Biden comes up with. And you have a Supreme Court that is very conservative and will shut down a lot of the radical proposals. The market loves this. So that's why I think the stock market's seeing that the Republicans are taking over and we have some gridlock for 2 years, and maybe somebody like Ron DeSantis will be president. Better choice than Trump, in my opinion. We need somebody to bring America together and not divide each other. If we have that, we could have a Roaring Twenties again.
Yeah. That didn't end very well the last time. We were Roaring Twenties and then a depression.
That's right. Well, this time it's a depression folled by the Roaring Twenties.
I see. Okay, well.
You know, it's the agony of defeat and then the thrill of victory in reverse there.
Now, okay, so yeah, so we should have a United Nations. But let's talk about some of the sectors that you like from an investment standpoint. And the risks to these investments. I've been talking to some people at this conference. People have cited risks such as inflation, supply chain issues, potentially even a food shortage. Nobody told me about a potential of a war escalating out of control. We saw recently Scandinavian countries like Sweden thinking of joining NATO. Wouldn't that escalate things further? And North Korea is testing new rounds of ballistic missiles again. I mean, they've been doing that for a while, but they're renewing tests. So it doesn't seem like geopolitical tensions are dying down. Do you think the possibility of war is a market risk?
Yeah, it's obviously a market risk, and Putin did something that was a major blunder on his part, and he may end up being tried as a war criminal. He ought to be, frankly. So I think it's backfired on him. And I actually think Sweden and Finland and these other countries, even the Ukraine joining NATO, is probably a good pushback to Putin. Again, if as a result we see nuclear war on a limited basis, not unlimited, but on a limited basis, that is going to be further backfiring of him.
What do you mean by nuclear war on a limited basis?
Well, I mean, I don't think he's firing nuclear weapons at the United States. It's going to be used on a limited basis in the Ukraine, and nuclear weapons can be used in that way. They're small and they're big weapons, right?
Sure.
And but if he does that, that's going to alienate even more people. I mean, Russia is going to be persona non grata everywhere. And they're already moving in that direction. China, frankly, is doing the same thing. And these are belligerent countries. And it is festering into a new level of Cold War, maybe even hot war. So I'm not ruling out nuclear war. In fact, I ask my students at Chapman every year, how many of you think you're going to see nuclear war in your lifetime? And 5 years ago, nobody raised their hand, not a single student. Now a bunch of students are starting to raise their hands. So I don't want to rule that out, but boy, that is a weapon of last resort for sure. And it could change a whole dynamics, and certainly gold would come alive if we had something like that.
I wonder, that's interesting. Your students 5 years ago don't see the possibility of nuclear war.
Right.
Now it's probably in the cards. We're not saying it's going to happen. The world has changed a lot, is basically the conclusion I'm getting from this. Given the changing world order, what are the investment implications of what we're seeing today? What are the sectors you like and don't like, and how should investors be positioned?
So I'm very much into income investing right now, cushions the fall. So I like energy stocks a lot. Oil is still holding strong. And so income investing in pipeline companies, in Exxon, Enterprise Products, these are stocks that we've been recommending, Continental Resources. There's a whole bunch of these companies that are really in a strong bull market. So I like that a lot. I also like utilities. I think those are really conservative ways to invest. I like Coca-Cola. Coca-Cola is up 10% this year. So that one's done well. Dow Chemical. These are Dow stocks that are up pretty substantially. The tech stocks, I think, are taking the brunt of the bear market. No question about that. I do think they have a good chance of recovery, especially the big companies like Microsoft and Apple and Amazon and Google. Those are good companies that we're actually starting to recommend right now. But the highly speculative companies, I'm staying away from those.
Okay. You mentioned to me in prior interviews that you did like the tech sector. Do you still like the tech sector after the correction that we've had?
Well, it certainly has pulled back pretty strongly down, Tesla down 30%, stuff like that, stocks like that. So I'm looking for a bottoming pattern right now, okay. But a lot of it does depend on the Fed, how aggressive they are in fighting inflation, how long this Ukraine war lasts. So there are some uncertainty out there, but I'm starting to warm up to technology stocks.
You almost made it 40 and slipped there, Mark. It could be like Russia's Iraq. Yeah, it could be a prolonged war. And then we're really going to have to see some trouble up ahead. But anyway, excellent thoughts, Mark. Thank you for coming on the show.
My pleasure. Good to meet you in person.
Finally meet you, the great Mark Skousen. Thank you for watching Kitco News. I'm David Lin.
Kitco News, special coverage of the Vancouver Resource Investment Conference, is brought to you by First Mining Gold.